Welcome to the Gray Report, where we're going to be breaking down all of the latest data and research involving the multifamily industry, commercial real estate. But all this data is going to change in a day or two. But we're going to drop some opinions from two individuals who have a lot of experience in the multifamily industry, Dr. Matt Bosnagel and myself. Great Capital. We've done well over $1 billion worth of commercial real estate transactions, managed thousands of units, and are actively in the market. So we're going to be taking a look at the data, kind of synthesizing it with what we're seeing individually just in the market, and try to come up with a really good direction on maybe where the industry is going to be going. So strap in. We've got a great episode for you. Let's do it. Welcome back to the report. Matt, how are we doing this week?
Pretty good. It's good to be back.
It is. So, Matt, we've talked about a lot of uncertainty. We've talked about how the data is coming out so quickly. And, John Chang made a video that's on the report today, highlighting just that of, as soon as some of these reports come out, we've got new data that makes them less useful. Because it looks like we're pointed into a slightly different direction. But still, we've got to we have to crystallize the data points at some point. And so we've got a slate of new reports. The first one from Yardi Matrix to give us a little bit of a snapshot of where the multifamily industry is going. Because we could talk about that we're at an inflection point for a variety of different topics, whether that's supply, how quickly it's going to recede in certain markets, the direction of inflation and the direction of interest rates. We've got owners that are looking to possibly sell or refinance loans by the end of the year. But the one thing, that's more fundamental to all of those factors, which they're all important, but how is spring leasing season going to play out? We've had a relatively subdued leasing season over the last couple of years, and with supply coming down in some markets and demand, appearing to be at a decade high for multifamily nationally, are we going to see some strength in April, May, June, and even a little bit in July that could, buoy some of these properties up, get those net operating incomes, the NOIs, to a better place where some borrowers, regardless of the direction of rates, will be in a better position, or whether to refinance, sell, or just to continue ownership of the property. But we're in a very just interesting time right now. So some of these data points are just giving us that kind of real-time feedback of, again, before we get into leasing season, but just that general direction of the market itself.
I think that one of the things that will become more apparent as the supply wave recedes is demand. Instead of it becoming a full story about supply, about you look at a market, how much supply do they have? How are they really getting dumped on with supply? Now we got to think about demand, and demand has a multiple drivers. Instead of supply, you can kind of look at construction timelines and get an idea of what's upcoming. But now for demand, there's multiple drivers, whether it's and in Yardi Matrix, they cite like immigration and job growth. It's largely, I would say, closely connected to economic growth. But in either way, it's a little more complicated.
Do you feel like there's been a little bit of build it and they will come, as in the developers built so many apartment units over the last several years? I mean, basically 50-year peak in new supply, but demand really stepped up to match those new deliveries.
That is what's going to be a really big question, to see if people moved into those new deliveries because maybe many of them were offering concessions and they were a little cheap because so much new supply. So you get a nicer apartment and get maybe 3 months paid for. But now as demand is becoming more relevant, it'll be places you'll have to pay attention to the job growth and these things that are related to the uncertain economy right now.
Well, that's what I'm wondering.
Ever more relevant.
As individuals in the economy become more and more uncertain. In last week's episode, we dove deeply into just investor sentiment, but also consumer sentiment, and that ties into, am I going to go and move out of my apartment with my roommates and lease my own apartment at the new apartment down the street. And again, we're begging the question is, maybe there's an assumption that, as supply recedes, demand stays high. And that's a possibility, but also, as supply recedes, so demand could also recede as well. And then we're looking at a scenario of if we're in a recessionary environment, I don't see demand accelerating. Typically, demand decelerates in a recessionary environment. Maybe it's short-lived, but still, some of the more the transient data, some of the data can turn on its head, and that is demand. Whereas supply is a little bit easier to forecast. And so we could be living in two very different worlds come July, of where we've absorbed a ton of units as supplies receded, and we've seen occupancy increase, rents increase. Or if we see that drop off in sentiment and we don't see that demand, we see those units still staying unleased, vacant, vacancy rises, and rent growth most likely doesn't just stay flat, might even turn negative one last time.
There is. And I'm glad that you even just kind of entertaining this scenario is really important at this moment because, and I appreciated this kind of message from Yardi Matrix as well. The market is set to be tested. That's what their little subtitle was. And like, I'll be honest, like when I was thinking about this, I was like, well, what is this test? It's like, it's kind of a gauntlet. It's a test where even the people that pass the test, they're not going to come out of this unscathed. So like we're all going to get beaten up a little bit if the economy goes down, and it's not going to be great. But we were talking about this beforehand. I think it does largely depend on where in the investment cycle you are and what kind of stage your company or your investments are in, and it also depends so much on the economy now. And that was where I kind of thought like, wow, as supply, we was reading their write up here is as supply wanes, man, all these demand drivers just become all the more relevant, and that's kind of what they wrote here. Is regionally, the top markets are the Northeast and Midwest, but across the country, there's just going to be those challenges that present themselves. The top line numbers for this report. Now, I still come for the headline and stay for the numbers, or whichever one you want. I still appreciate the just these basic numbers here on rent growth. So 1.2% year-over-year rent growth for the nation, 0.1% month over month. Now that compares to Real Page's 0.8% rent growth, positive 1% for CoStar, a 0.4% increase for Redfin, 0.4% for Apartment List. So we're all getting very close. A 0.4% decrease for Apartment List, I'm sorry. But we're all falling, all of them generally falling from like maybe a positive 1% to 0, maybe a little under for Apartment List. But this one's definitely on the higher end, but that's not to say they don't have kind of everything in order. We'll see an example in another of these reports that kind of showcase how different they can be. Regionally, again, all of the top markets in the Northeast and Midwest, as this supply winds down differently for different markets, I think that we could see vastly different rent growth patterns as the supply wave winds down. Now, I do think, though, if in the case of a recession, that difference may not be as pronounced. So if everything's all the same and suddenly now we're looking at the different supply, maybe the Midwest, the supply wave has already receded, and in the South, in a lot of these markets in the Southeast, South, Sunbelt, et cetera, they're still dealing with this elevated supply. So you could get the market divergence, but I think in the case of a recession, that market divergence may not be there because it's suddenly important to have job growth. And a lot of these oversupplied markets have a lot stronger job growth.
Yeah, and Yardi always includes a table of kind of economic leading indicators, specifically rent growth, job growth, and completions as a percentage of the total stock. And it's interesting. I mean, you have at least these completions of the total stock definitely coming down from where they were 6 months ago, especially a year ago. I mean, there were a lot. Now, if you go down to the bottom, we can see a direct correlation between completions as a total stock. You can translate that into how much new supply has come on in the last 12 years and rent growth. I mean, New York City, which let's not talk about New York City because it's got its own unique drivers, a lot of large population, negative population growth. But I mean, Kansas City, 2.8% of completions as a percent of total stock, and 4.1% rent growth.
Yeah.
Job growth coming in at 1.3. That's pretty healthy. Columbus, Ohio, similarly, maybe a little bit higher on completions, of 3.5%, with about 3.8% rent growth. Now their job growth over the last 6 months was slightly negative, basically flat. And then really we've got a lot of other Midwest markets and a couple of Northeast, which that's the theme throughout all the reports, whether it's Yardi, whether it's RealPage, across the board. We're seeing Midwest and Northeastern markets really outperform. And the Sun Belt
multiple locations
really lagging behind, with the biggest example of Austin. If we go down to like the bottom of this table, again, it's a collection of some of the popular multifamily investment markets that you hear about on LinkedIn so much, but 9.2% of completions of percent of stock for Austin, Texas. That's translating to a negative 5.1% rent growth. And while job growth is relatively it's fine, these job growth metrics, because again, people talk about population growth, and population growth is important. It's a metric, but I show you a big chart of population growth metrics and rent growth and returns, and they're not as correlated as you'd want them to be, or those individuals may think. And
job growth, you get a job, you can move out.
Well, the jobs are the true barometer of economic activity, and it's typically a better leading indicator than just pure population growth. Population growth is typically kind of lagging a little bit of that.
Now it is super interesting to see how the job growth basically. I don't see any number higher than 2.4% right now, which is actually Indianapolis. But there are a lot of these places like Austin, 1.6%, and it has 9.2% completions as a percentage of current supply in the past year.
And so we ask ourselves this. And we do this every day. We've done it for a long time. But why would I invest in Austin?
Well, so
with negative rent growth
to their
supply.
To their credit, I think that if you look at the job growth 2 years ago, I bet in Austin, it'd be
probably
a huge amount.
No,
but
good point. And they've got a lot of population growth as well. And there are definitely a lot of jobs, and it's a decent size market. But whether it's, again, when you're looking at employment growth sub 2%, not really kind of breaking out of the national average, you're right in the pack. Why pay a 4 cap in Austin when revenue is growing and you're not necessarily seeing as all the positive economic drivers? Again, just if we're looking on these metrics alone, comparing it to Indianapolis, growing rents at growing employment by 2.5%, rent growth is positive 3.2, and relatively moderate. Completions representative total stock of 3%. If anything, that 3% rent growth with 3% completions, that shows how much net demand there is, in the face of a decent amount of supply, just not record breaking. It's an interesting dynamic.
I agree, and it's only going to get more complicated and interesting in light of the kind of uncertainty here. I did like this. They have this in their summative paragraphs in the beginning of the report. They say, after years of stability and consistent job growth, the country is getting a dose of new policy that has roiled the financial markets. Some estimates put the number of layoffs in February at more than 170,000, the largest number since the global financial crisis. It's going to get, the market is about to be tested. I think that it's going to be interesting how these policy changes shake out. They're not yet recorded in these investor sentiment surveys that we'll cover in a minute.
Well, that's what we've been talking about a lot, is that there's a lot of sentiment surveys for the first quarter. And were these taken in January, February, or March? At what point in the quarter? Because, January 15th, that there was a much different vibe in the economy than there is March 15th. Huge difference. Just since, the tariffs, the end of February, beginning of this month, once tariffs became more of a reality and less of a threat, but now it's just the confusion of what it actually may end up being. We're just living in a different world than we were. But I don't think the current state of affairs is one that's going to continue either. So, where are we going to be in 3 or 6 months? I've been thinking about this, and not to jump forward to talk about politics, but I don't think Elon Musk's going to be in the White House for 4 years. And so some of the volatility just related to Elon is not going to be forever. No, we still have Trump in the White House. So
We can talk about it now. Let's talk about it now.
you want to talk about Doge?
Yeah, let's talk about it now.
Okay. Yeah, a lot of articles on Doge because it intersects right with commercial real estate,
Yeah.
Especially office real estate, which didn't need to be kicked while it's down, but that's essentially what's going on. But it also affects, employment rates, and all of those workers have to live somewhere, so it could potentially affect multifamily and the economy. Probably not wholesale, but definitely some impacts here or there.
Yeah, and this article from BizNow actually deals with people that are renting from or the properties that the government itself holds and how they're selling them now and the uncertainty there. And I do like this.
I like this.
The opening quote: "The race to slash the federal government's real estate footprint has created a bewildering gauntlet for brokers and landlords that work with agencies." Again, they've got their own gauntlet to deal with, and this deals with this plan to cut a lot of the unoccupied, or maybe it is even occupied, real estate held by the government, which of all the things that are being announced, I think that one could make sense. I could see if it's an empty building, great. If they're keeping it just in case, though, depending on the percentage of it being used. So I get all these pictures of these empty buildings, and they're like, well, this isn't used, but like, are they required for some reason to always have it on hand? But that's a lot to ask.
There's no nuance in any of this.
Yeah.
Which if you had to study the issue to make all the right decisions the first time, it would never get done. It would not get done.
Very good point.
I sort of understand it, but in this article, which is really interesting, there's a lot of really good anecdotes from people brokers that are kind of caught up in the middle of some of these leases.
Yeah.
These negotiations, some were in the middle of lease negotiations, some are just getting notices, and there's no one really at the helm, seemingly, or like anyone to talk to.
Yeah.
That's what almost everyone that was quoted in this article said. It's like, I don't even know who to reach out to at the GSE about discussing this. And it essentially just sent out lease cancellation or early lease termination notices to all of the landlords that they thought weren't absolutely essential, regardless of whether that they legally could break the lease, but just to let's see what will stick. Let's see who pushes back.
Yeah.
And it's left, owners, brokers in complete limbo, not knowing where it is, because they're having a hard, just these notices are going out, but there's no one on the other side from the government to speak to about it.
Yeah.
Because GSE, has had major workforce reduction efforts as well.
Yep.
And so the same people that are working there aren't working there anymore, and no one knows. And so these leases are complicated. It takes a lot of digging into to see, what the government can actually do. Yeah. But it's the biggest. My favorite quote on this piece is that the GSA, the reality is GSA has always been dysfunctional. This is just a new dysfunction. Yeah. It's always been frustrating. Working with HUD is never like a walk on the beach. It's going to be frustrating because it's going to take 6 weeks for them to turn something around. And how could it take 6 weeks? What else are you doing? Yeah. But this is only going to exacerbate it. Of where you're not going to get a response. The person isn't there. The person's been let go, and no one is even notified to fill that position. So again, if there's drama about the the U.S. Institute for Peace, what I don't know exactly what they do. It's like if that goes away, I don't know what's getting
rid of all those nuclear scientists, but maybe they had them back. I don't know.
And were the nuclear scientists protecting our arsenal, or were they just working on updated because we're doing a remodernization of a nuclear arsenal, and it's like, I don't know, do we need better nuclear weapons? I don't know, maybe we do, but it's all just done with a hacksaw. Which again, the balance is without the hacksaw or the chainsaw, does anything ever get done? But then but then the flip side, you are absolutely drowning the baby.
Yeah, and there's the idea of Congress setting the budget, but that may not be the case if I think that the part of the budget
throwing it against the wall and seeing what sticks. Yeah, I mean, it's fascinating.
But anyways,
there's some really interesting.
I'm not. Sorry, I do have some ideas separate from the thought of what counts as waste and what doesn't count as waste.
Okay.
Not even looking at this is how I treated this issue, and because I don't really want to get political. I just want to say, all right, they're getting rid of jobs. What's going to happen? And if their plan, and so that kind of what led me to this article from the Urban Land Institute is if Doge. Now, at one point, they did promise to cut the federal workforce by 75%. And Urban Land Institute said, well, okay, let's exclude uniformed personnel, which was like 2.3 million. Let's exclude maybe postal workers, which is like 700,000. And then you get 2.1 million workers that are civilian workers. And I don't have the numbers here. I'm going to have to look it up in a second here. That is 1.7 million jobs that it would that they would end up cutting in total if they want to cut that 75%. Now, I don't think I think they're coming well short of it, but even the 100,000 jobs that are in some estimates of them cutting, that's a lot. I mean, last month's employment numbers, they added 150,000 jobs. So I don't know if that was already factoring in the 100,000 left, but 100,000 is a good chunk of any month's employment numbers. So
I think what they fluctuated. I mean, the last year or so between a lot of them were like 200,000, 100 to 200,000, monthly jobs added. So it's a big chunk. Is it something that? But it's also dispersed across the country. But still, I mean, that's not going to help the unemployment rate.
Yeah.
And that's what they've tried to do a little bit of estimating. You can go here on the urban.org, the ULI. You can look at kind of what the current unemployment rate by Metro statistic, and then the estimate. And it does tick up a little bit. Especially, this is looking at some of the counties with the biggest differences.
And some of those counties are like military bases where there is a higher proportion of the kind of civilian government employees, not the military one, but the ones that support it. And it could be like 15,000 people in a community of 20,000 or something like that.
There are some markets where it's like that is the town.
And and it's in those places and that was Urban Land Institute's point, is that a lot of smaller communities will be disproportionately affected, but it's like if the company employer pulls up stakes, that means
factory town,
that the flower shop and the bakery and everything that was supported by the wages of those people will go down. And I'm only saying this in counter to a lot of people will disregard government employees when it comes to employment numbers, but like they're still jobs. These are still jobs.
Very true. Still jobs, still people.
And they still contribute to the economy.
And there's a couple different perspectives to have. I mean, one from the individual level of anyone losing their job is a horrible story. From the investment level, that's why you want to be careful investing into markets that have high concentrations with single employers. The Army base is like the classic example, but it could be one factory, one just major employer, because if they go out of business, your whole thesis of all the growth, all the stability goes away. And the United States, I mean, we're trillions of dollars in debt. Certainly we've been heading towards some level of insolvency. We've been adding to GDP growth over the last couple of years, especially by adding to the federal government payrolls. So a lot of the employment gains that we've seen over the last couple of years have been by just growing government. So you could make an argument we're just going back a couple of years under the size of the federal government. Certainly not by if the full 75% gets cut. Yeah. But I guess my point is, if you weren't aware that the federal government at some point needed to be reduced in size or some drastic action needed to be taken, whether that was looking at entitlements or reducing our spending, wherever, raising taxes even, it gets thrown on the board, not my preferred method. But I guess it shouldn't be shocking that some sort of disruption to how the federal government is organized and operates is taking place, given the amount of debt, given where rates are, with over $1 trillion of the budget is now being used to service interest on the debt. So something has to change. It's in a very violent, all of a sudden, and unsympathetic way to a lot of people that are probably doing a good job at what they do.
Yeah, a little bit more attention and a little bit.
Is that callous?
No. I think a little bit more
Take?
attention to the speed of things and to the fact that like not only are these people losing their jobs, guess what? A lot of them are going to go right back on the jobs market, and they're going to pick jobs that compete with a lot of other people's jobs. It's just like kind of office work, and it's a large amount of like the professional economy.
And that I don't think is necessarily a bad thing over time. That if this money and these employees are shifting from the public sector to the private sector over time, that's a good thing. It's just this period of disruption is not necessarily doesn't give you the warm and fuzzies.
Yeah. But we can talk about how you should react to it.
Where should we go?
First, I think panic, but I guess Marcus and Millichap have a little bit of a different idea. I always like to panic first, and then then I look at the numbers. This one's called High Speed Cycles Require Long-Term Thinking, and fairly describes, actually, I think, the methodology of our latest report, which you can download at graycapitalllc.com/window. But also, John Chang does a great job of keeping with the pulse of what people are talking about and the current events. However, this is more related to medical office. He talks about some demographic shifts and the aging boomers and his specific points about medical office, but it did help me to, it always helps me to, as a jumping off point and as a way to frame a lot of the issues that we're seeing here. Specifically, this idea that the data is not really helpful. For the past few months, there have been shifts from optimism to pessimism about the market, along with changing interest rate assumptions. There was a time, I think it was like August and September of last year, when rates were really low. Expectations were super high. But then by the time NMHC rolled around, that enthusiasm dwindled. And now, even past NMHC, we are in this like post-dwindling where with economic uncertainty, there's a shakeup to come even, I think. And that means that like some of the investor sentiment surveys that we see here, I looked at, they're in January and February, and it's like, well, are they thinking different now?
Well, there was a period where everyone saw a new administration coming in, and everyone was like, "Oh, great! We don't know what Doge is, but it's going to make the government better. That's good. Reducing government spending. Like, I don't know how we get there, but that's good. But by the way, also huge tax cuts. Oh, that's really good and exciting. And we're going to bring back 100% bonus depreciation. Oh, that's really exciting. All of these good things that were
getting rid of the penny.
About. Yeah, getting rid of exactly. Fine. And so like, all of these like pro-growth, plans, but then once we started, it was like, oh, yeah, we're not going to do the pro-growth first. It's all going to be like, no carrot yet. Like all stick. All stick.
Yeah. That is. It's almost word for word what I've been reading in a recent article for sure.
Yeah. Well, maybe they copied me.
That's right. Yeah.
But so John, and we this is how we started the show today. But I think John Chang really hits the nail on the head of these just policy or vibe shifts can be so dramatic and change the narrative and change the forecast, and because sentiment can change that quickly, and sentiment and psychology drive markets, and I think that's what has really taken place over the last 2 weeks or so. It's a day, again, we talked about during 22 and 23, even 2024, it was like, we felt like we were on every 3 week cycle. It was like a 21-day cycle. Yeah. Now we're on every 3-day cycle. Yeah. One day cycle, even, hour by hour.
It's hard to.
I mean, I know like Trump and Putin were on, phone call, today for an hour and a half. Who knows what tomorrow is going to bring. The fact that we're talking about, and we're getting a little bit off topic, but European equities are now highly favored, and there's actually growth going on in Europe because, and a lot of this is just because they're investing in their defense industries now. But European equities and European stocks have been like the boringest thing in the world for the longest time. Then all of a sudden now there's some opportunities and some growth. And U.S. equities have been getting beat up over and over again. There's issues with NVIDIA and with China and DeepSeek and the direction of the AI kind of dominance and kind of the struggle for who's going to kind of lead the charge. It moves every single day.
Yeah.
And I mean, that's why we put out the research report, Multifamily Window, 2 weeks ago to try to give some clarity on the long-term fundamentals, because the noise can keep you distracted and indecisive. Whereas if you can quantify the noise a little bit, so you can discount it and you can step back and see some perspective of, okay, we're in a period of dislocation. These periods don't last forever.
Yeah.
They are absolutely the periods of where you can find the most opportunity, and you have to position yourself to take advantage of it, but you have to do that with confidence. You can't be worried that you're catching a falling knife all the time.
Yeah.
Not that you ever have 100% certainty, but you can arm yourself with the fundamentals and the facts. You can filter through some of this and be like, all right, yeah, it's not going to be bad. That could be bad in the short term, but we'll be able to move past it.
Yeah, understand what trends you know, what trends you can kind of count on, and the numbers that you don't know. Like, for instance, the video says steel prices have gone up 30%, but the CPI hasn't shown up in the CPI. CPI actually went down in February, but like, what should be familiar to those who know about CPI's lagging rent growth data is, like, CPI often moves slower than reality.
Yeah.
But that doesn't mean it's not that it's not useful. It's just you got to know what you got to know what you can follow. And one of the things that we talked about in the multifamily window report is the fundamentals of apartment supply and demand. These slow moving, longer term trends of apartment supply and these drivers of demand, whether it's job growth or household growth. The scary thing is even those drivers of demand now are thrown in a little bit of flux. But I again would fall back to the long momentum that we saw in 2024, just everything steadily building. And it's something actually that we can see when it comes to investor expectations as well. They're long improving momentum in 2024, little shakeup in Q1 2025. So this is going to be exciting. Every week we will have something new to share. Maybe next week it'll be everything will shift to good.
It will, yeah. We'll get a couple of data points, or the tariffs will be receded, or if there's just a regime of where we can plan on tariffs and some related things, that reduces some of the volatility significantly, especially in trade. But this next report, we have 2 reports on investor sentiment, one from Berkadia and then the Fear and Greed Index from John Burns Research, as well as CRE Daily. Both are really fascinating. Both kind of share similar conclusions, I'd say. Yeah. And I guess, it begs the question we were talking about this right before. When did they take this survey? Yep. Was it in January? Was it in February? Or was it last week? Because I think you'd have different outcomes. And
it's like the first thing you think of.
Let me ask you, after reading these surveys, when do you think that these were done, Matt? Just reading the results of some of the surveys.
Oh,
do you have a
I know
thought?
when that was the first thing I looked at, but
okay, well, then
but
tell
I think
us.
they're
or
characterized.
when do you think, and then you can tell us.
Yeah,
what
I thought going into it was, okay, these were probably all late, like December, January-ish, when things were a little bit more optimistic, but not fully baked in with pessimism. Like the lead up to NMHC, that period from basically December to January was this, like, okay, rates are going to be higher, but like there is a case here. But still, a little bit of a hitch. There's some hitches. We'll see.
Yeah. So the February 20th, is this the date? The data, February 25th?
February, yeah. February of
February 25.
Yeah.
Ah, yes, the date, years. That makes a lot more sense. I was like, that's a...
And that's another difference here. The Berkadia report had surveyed 240 senior level clients, and the John Burns Research and Consulting Fear and Greed survey, along with CRE Daily, they had, 1,064 respondents surveyed. So a little bit probably different, the makeup of these, and the questions they ask and the ways they crunch the numbers make it so that it's worth reading both, of course, but we will summarize both if you don't want to read any of them.
I mean, my takeaway, Matt, from reading both is that there's a surprising amount of... It's more bullish than not. I guess people are leaning towards, hey, I want to be able to take advantage. I think there's going to be some opportunities, especially in multifamily. Yeah. But it's not very clear.
Yeah.
It's not at consensus by any means, and it's marginally bullish rather than just absolutely neutral.
If you want to start actually with the John Burns, because then
Love
I have
to.
something that speaks to that
Love
point
to.
specifically. If you go to just some of their quarterly numbers, you can see it on a lot of different measurements, even here. So this is just overall Burns fear
This
and greed.
is CRE, all commercial real estate, not
Yeah,
multifamily.
yeah.
We break out asset classes.
And
later.
they do break it out in later in the report.
Yeah.
But overall CRE, it goes steady improvement, a little hitch at the end, maybe it's constant at the end. So it starts in Q1 2024. This is the first time they had the survey.
And tell people what the
Yeah.
about
So
the,
fear is
the
zero.
scale.
Fear is zero, and that's people. They don't want to transact. They think it's going to be a bad environment for investment. And then greed is very positive. They intend on transacting. They think that it's good for investment. So we are actually
40 to 60 is neutral, I think.
Oh, okay. And we are well within neutral, maybe a little bit positive. So we're at 51 right now. 56 right now. And that's improved from 51. So all throughout, and this is my larger point here, all throughout 2024, each successive quarter, there was improvement from 51, 52, 53, 56. And now at Q1 2025, we have stayed the same. That may be meaningful. That may not be. I think it gets a little bit different with multifamily. If I have my numbers right, multifamily, it went down a little bit.
Yeah, I think from 60 to 59.
Okay, yeah.
And just a correction on 55 indicates, like positive, like we're moving in the right direction. Any number above 55, anything below
okay.
45 implies a contraction.
Well, then what is the difference between 51 and 52?
51, 52 is just slightly neutral, but slightly
yeah.
marginal.
But again, the higher numbers, and then we're sitting at barely expanding, I guess, if we're at 56 right now. The other interesting facts here is how they have calculated what investors expect to do and what they have done in the past.
Yeah.
So they've run this survey long enough to know that, like, all right, what do you plan on doing in the next 6 months? You can track that back. Basically, most investors have been in wait and see mode. It's in the 60s. Currently, it's 64%. But in the next 6 months, there's only 44% think they'll stay put, and like 46% think that they will transact. Now, that's true for like every month. Usually, it's about basically your expectations are about 20% greater than you end up than you end up actually fulfilling, and I think that's fine. That's optimism. There's
only some optimism in here. I mean, most people are saying they're going to increase their exposure,
and that's my other takeaway too. And I've noticed that you're serving these investors. They're investors for a reason.
How many of them are like, I'm in the business. If I don't increase my exposure,
exactly.
Then what am I doing here?
So I think there's a little bit of a bias, but still, it's worth tracking these trends here, and you can see the expected CRE investment strategy in the next 6 months, it dipped a little it dipped from 68 to 66. I don't know how meaningful that is, but
it is a change.
It is a change.
Yeah, it's not better. It's not improving conditions.
Yeah, again, like all throughout 2024, consistent improvement, and now we're at this little bit of a hitch. We've had a quarter.
Well, and that's why I was wondering if this survey was done last week, how different
for sure.
it would be.
Yeah, and they have questions about regulations, I think, on both of them, and it's I wonder if it's going to be different if you ask them. Now, February, that's only a few weeks ago, so maybe that was top of mind, but still the. Investors, when they talk about what their challenges were, it was interest rates at 42%, then expenses at 20%. I'm sorry, for multifamily specifically, interest rates is 50%. That's the biggest challenge, huge. And then operating costs at 22%, oversupply at 15%, policy and regulatory risk way down at 9%. But you're scrolling down there. The asset values for multifamily is another. So kind of sore spot. It in multifamily assets and office assets were the two asset classes that investors saw price declines.
Yeah.
I think their expectation of 0% price change in the next 6 months is probably fairly valid. Multifamily had gone from losing 17% in Q1 2024 to now it's losing 7%. But you sure would like it to lose 0%. It's still well above office, which is
it depends on what you're trying to do. If you're trying to sell, sure, man. If you're trying to buy a bunch of multifamily properties, you don't mind this because either, like we've talked about, interest rates have to come down or values have to come down to make transactions work. Rents can come up. They're not gonna move enough generally to like absolutely change the picture in the time that folks need to. So
for sure. And
again, this is one of those data points where I think sets up an interesting opportunity to buy near the end of this year and into 26.
For sure. I would totally agree. I think that especially because like the long-term investment, even these baseline investment prospects, they compare the average IRR and it's tied at 9.9% with industrial and their mortgage rate is at 6.3, which is the lowest of all these property types. So there's definitely some reasons why people would prefer multifamily over other property types, just based on those two pieces. Now,
let's switch over to Berkadia.
Now, this is multifamily specific, so I don't have to slice and dice that much, and I can just say, I don't have to give the average and then multifamily specific, but that's fine. This is the first report of investor sentiment from Berkadia, so this is more of a snapshot, but still some interesting questions, and you get some expectations I just like I like having a second source right at the same time. So I was looking at the Berkadia one first, and then I was like, let me compare their optimism with the optimism from the Fear and Greed Index. Well, I will say this right now, Berkadia investors are way more optimistic. 86%. Compare that again to like the 56% for the Fear and Greed. 86% of the 240 senior level clients said that they would either moderately or aggressively expand their holdings. I'm sorry, CRE dailies is at 59%, so about 27% bigger. That's a lot. 63% also think that renter demand will exceed supply, and they think that rent growth will moderately increase as well. Just running down these top line numbers, it's kind of interesting. They have all these relevant things. They think Fed fund rate will have 25 basis point cuts. 10-year Treasury will be around 4 to 4.5%. Rent will again moderately increase. Most thought that the Southeast was the best place for multifamily investments in 2025.
I wonder how many listings they have in the Southeast.
That is something that I've also thought about. And whenever I'm thinking
Where do we have to sell the most properties to hit our volumes?
Yeah.
Where's the most volume of deals? I'm not saying that influenced the number. I'm just saying that, are there any metrics associated with this?
No, but you can see the relative position. Yeah, I looked for the numbers there too.
I'm just saying, what other than you've got a bunch of owners in the Southeast who are like, I need this to improve. I've got to turn my property around. This is like, we will will this into existence.
Yes.
Or we will manifest this. Let's get out the crystals.
I can't, because let's just say, perhaps, maybe they're talking about it's the case where high supply in the Southeast leads to investment activity. And so, and we can't predict the future. Maybe Southeast rent growth is going to improve dramatically.
It will at some point. I think they're just waiting for Jupiter to be in retrograde.
Yeah, that's good. All right, that's funny.
And also Texas. Like, are we talking about regions? Or are we talking about states? I guess Texas could be its own country. I get that.
And maybe they're saying like the apartments will be so cheap. Where's that's
California
the only way.
On this list?
It is weird, but it's interesting.
It's like countries, and it's like Africa's on there, and it's like,
well, yeah. I wonder if they describe the regions first, or they just had people fill in the blank, and some people as a region put Texas instead of.
Oh, you mean it wasn't made up?
Yeah,
you mean it wasn't just made up?
Yeah. Like maybe it was. Maybe there's a lot of people that put Texas in there instead of
They wrote it in.
Yeah. They wrote it in. All right, but. Again, like, I can't predict the future, but in the past, if we are going by past performance, the Southeast on average has the lowest rent growth and occupancy than other regions.
It's still supplied to deliver throughout this year and early 26.
Yeah.
Long term, I mean, obviously, the Sun Belt is going to do really well, and the South is going to do well. You still have people moving into the Sun Belt. You're going to have, you're going to find a better balance between supply and rent growth and all of that, and there's going to be could be some other challenges, whether it's climate related or whatever. It makes sense. I just think that at some point it has to move down off of the top for a minute. And again, the North, it's interesting, the Northeast and Mid-Atlantic, which has been one of the best performing regions, and maybe because they're saying, all right, it's had its time in the light, it's time to cycle out. But the Mid-Atlantic and the Northeast have been doing really well fundamentally.
Yeah.
Take out the population declines from New York City.
Yeah, arguably the strongest if for when it comes to occupancies. So the recent RealPage report had the Northeast and Midwest tied for rent growth, and the Northeast actually edges out the Midwest when it comes to occupancy. But it is interesting, at least currently, most investors are in wait and see mode. But in the next 6 months, we'll see.
Yeah. I'd say a lot of people are in wait and see mode. But again, for a lot of the short term trends, but again, that longer term, I think there are very few individuals that are saying that I don't want to buy anything.
Yeah.
Not as many who are taking steps to actually do it and look for deals. Everyone is optimistic. I think people acknowledge the long-term outcomes. I just think that there's some attrition going on in this period of depressed activity. Sales volumes are down.
Yeah.
Rent growth has been negative. Rates are high. It's not been an easy market over the last couple of years, and it would be easy to be jaded and also not react quick enough because you're kind of in wait and see mode. Even though you can say, yeah, we want to go out and buy something, but there's nothing in the market to buy today. If you tell yourself every day that there's nothing out there to buy, it kind of gives you an excuse not to do anything. Of like, well, it's not in my control. I just need to sit back and kind of just watch the world and wait until I get the all clear. But who's going to give you the all clear? Yeah. There's not like we don't all have like a beeper.
Well, just to
J. Powell's like, now's the time. Yeah.
Just to kind of also reiterate the point of the Yardi Matrix report is like it's going to be tough. No one's going to get out of this unscathed, especially if there's an economic downturn. So there's a great deal of risk that we are approaching. But if you scroll down to the end of this report, and they actually have a similar section in the John Burns Research and Consulting report.
Yeah, like some quotes.
You got some good quotes, and they're very nicely anonymized. So it's like managing director or president at private equity firm.
Like handsome managing director.
Yeah. Try to read who you think this is based on the quote. No, that's funny. But a lot of the themes was there's still a lot is the idea of, well, some people are going to break, and we're here to snap up those opportunities. That was. It's like these difficulties could push people too far, and rates aren't going to bail them out. That was Can you scroll back down to the quotes? I just want to see. What is it? Yeah, sellers are not willing to sell at cap rates when buyers can achieve at least neutral leverage. Sellers who don't have to sell won't. Some sellers who need to and can't will have plenty of financing options to kick the can down the road. That's a little bit more pessimistic, but I think that there are. Here's one that people who survived until 2025 still need to find some sort of solution to help them continue to operate. Interest rates are remaining elevated and lower than anticipated rent growth. That's the reality check that I was kind of looking for. And I think that overhanging that is this idea that maybe they will be there to pounce on these opportunities. I'd like to think so, because if they're all expecting to expand, everyone always loves the idea of this opportunity, the opportunistic, but you have to be there when it's scary, I think, to really move it from the expected to the, all right, yeah, we expected, but we wait and see it another year, it's hard to move from that. And the numbers say, you always expect, but you end up waiting, seeing. There's lots of risks.
And, the equity isn't necessarily going to be there either. Just because the opportunity is there doesn't necessarily mean the equity is up to speed with the GPs and the managers.
Yeah, that's a really good point too, and that's something that that one of the reasons why we made that report was to frame the issue and according to what we know and how to explain it to our investors. And we're responding to concerns from our investors about the general economy. Yeah. And it's not like the deal itself was bad, but we're like these are the projections. This is what we know. This is what we don't. Sometimes consumer sentiment slips into investor sentiment.
All the time.
And I would love to know the difference between the population of investors surveyed from Berkadia to the population of investors surveyed by CRE Daily, because I think that if it's your business to get investments, if you're kind of like multifamily or Gray Capital, then we're more often than not, we're optimistic. Like we're, gung ho. We're going to really try our best every single year and grow. But individual investors may be a little bit more reticent. It's like, well, I don't have to. That's not my imperative.
Yeah, I'm not sure. I think the Berkadia participants are much more curated in terms of again, I said they're active
they're
clients,
senior level clients,
senior level clients, which is even fancier. Whereas CRE Daily, I don't know if just any Joe Schmo can hop in for the John Burns and CRE Daily, but I participated in this survey. Berkadia
cool.
did not ask me to do theirs. Maybe we're not a senior client. Come on, Chris.
We'll work on that.
I'm joking.
I have a feeling that because this is the first time that Berkadia has done it, I'm looking forward to maybe they'll expand their survey scope, and we'll see how things go. That's cool though. Yeah, a really great coincidence that both of them showed up at the same time, and also all these reports from RealPage, Yardi Matrix, and Redfin giving us a good snapshot of the market doing a little bit better than it did last year. Still maybe not quite up to snuff according to historical average, but there's that momentum. And there's this momentum even when it comes to investor interest. But we'll have to see if the hitch turns into like a dip and then a slide or something. But that's
there's
why
momentum.
we're here every week.
The problem is no one knows what direction that momentum is pulling us.
Yeah.
Is a little bit more unknown. And that's what's keeping it interesting. That's why you need to make sure you're subscribed to the Great Capital YouTube channel. And you're getting the newsletter, which you can get at greatcapitalllc.com or go to greatreport.com. The links are going to be in the description, but we send out 2 newsletters a week to basically deliver these reports. So if you want to get these reports sent directly to you, we do that as a free service. Free service, Matt.
Yep.
Just doing it for the good of the community. We should start charging.
We should. I'm trying to
one day. So
premium
get in,
tier.
Premium tier. Great Cap premium. Great Report premium tier.
Yeah.
Leave a comment. Let us know what you think about the episode, what our thoughts are. I'm curious, just kind of getting your take as well. What are you seeing in the market?
Yep.
I mean, do you see a recession currently underfoot, or do we need more data and it's just too volatile to say, and will the narrative change? It almost certainly will. But yeah, just always curious on we're looking at the data, so I'm just really curious on some of those anecdotes, those really true tip of the spear leading indicators that might give us a direction, and then it's going to change again. But we'll just stay with us. We'll be with you every step of the
each
way.
week as it changes.
All right. See you in the next episode.